Okay, everybody, welcome back. It's Magnolia on Money, our weekly market report. My name's Ed Cox from Magnolia Wealth Management, and we are now in 2022, which is unbelievable. We're already in 2022. I wanted to review what happened the end of last year, go over kind of the asset classes that did well, the ones that maybe didn't fare as well. I wanted to touch on a couple of, I guess, talking points that people ask me all the time. Ed, how's inflation? What's going on with inflation? And then how do we compare that inflation to the past? And also government spending and our debt. How does that look? What does that look like compared to previous years? So we'll touch on those two items. We'll look at what we think this year. 2022. We're already here. We'll look at what we think 22 is going to be, like in the markets. And then also a couple of things that as we look back over the last couple of years and the pandemic we went through and how markets reacted, why why did Magnolia do the things that we did? Why did we stay invested in times that were unknown, and what are the reasons for that? So I want to touch on some of those to help you understand why we made some of those decisions that we did. So let's dive in. I do want you to see my screen, so I'm going to swap over here so you can see my screen, and let's dive in. All right, so the first slide here, really just want to go over what 2021 gave us in the market, okay? So these are asset classes. So we have real estate, large cap, commodities, small cap. You can go back and look at the others. I'm not going to discuss the other years. I'm just going to look at 2021. We had a great 2021 in the market. Real estate led the pack at 41.3. Large cap stocks were up big, 28.7. Commodities, 27. Small cap companies, 14.8. We had developed markets that were up 11.8. Let's jump down here. Our fixed income, our bonds, down about 1.5. High yield bonds were up some. This was one that a lot of people may not have seen, thought would do a little bit better, but our emerging markets were down 2.2%. So compared to where we were, in the U.S. large cap and small cap, that's a big swing. So what happened? Well, Chinese stock market had a big correction as they continue their lockdown measures, throughout the region. So that hurt them a good bit. But all in all, 2021 was a great year. Wonderful, wonderful, wonderful returns in the market. And, this year, I think we're still going to have a decent year in the market, but I think some of these returns are going to be subdued. And I would not expect this kind of robust returns for 2022. Inflation. All right, we get asked inflation probably more than any question. Well, we did this past year for obvious reasons. But I wanted to show you a little bit of inflation throughout the year. So this goes back into the 70s, where a lot of people think, oh, gosh, Ed, are we going back to the 70s when inflation ran rampant? I don't think so. I think that our inflation is actually it is sticking around longer than we had hoped for. But where we are right now, we're still not near where we were back in the 70s and at the high points. But it is a concern. Inflation is one of those things. The longer it stays around, it grows roots and teeth and can get out of hand. But we're hoping that supply chain issues are fixed and we can get kind of back on track. But one of the things I will point out is a lot of times you hear what we call our core CPI or core consumer price index. The big thing about the core consumer price index, which is that darker line, it leaves out food and energy. Well, look at the difference when you include this lighter blue is called headline CPI. That includes food and energy. Well, look at the disparity between the two. It's a big difference. So I typically look at the headline CPI, consumer price index. I look at that because it includes food and energy in that number. Okay. So, I think it's definitely something that that you should be watching for. But inflation's real. It's here. We're hoping that this year, it won't be quite as high as it was in 2021, but we are going to still feel it in 2022. Budgets, debt. Let's talk about that. So this top left quadrant here, you can see the total government spending, what it's spent on: Medicare, Social Security, defense, non-defense. So 5.5 trillion is our federal budget for 2022. You can see where the sources of financing are coming from. So corporate, income, social insurance. So you can see we're shy about 1.153 billion. 1,153 billion. A lot of money. So we're short over $1 trillion in ours, or 21% of our budget we're having to borrow. Very concerning, very, very concerning. When you look at the national debt to GDP over the history, yes, back in World War II, when we were trying to win a war, we were borrowing everywhere we could to raise money to win the war. We were higher than we are today when you look at GDP versus our debt as a percentage. But it's concerning. It's really concerning that we continue to tack on more and more debt. And you can see how it's just, the last few years has really taken a big toll on our debt. But something that we're going to pay attention to, and how we get out of this debt situation is going to really kind of determine, I think, how the next 10 years in our market are going to be, and what are some of the inflationary issues that we face or going to face, could affect us. So definitely something that we watch and take a look at. So let's look at forecasts. So this is a forecast from CNR, City National Rockdale's forecast. They're kind of a good middle of the road when I look at different companies and economists on what they expect for next year. So 2022 estimates, we're looking at, I would say, real GDP showing 3.5 to 4.5%. That's a good solid growth number. 2019 was at 2.3, so that gives you an idea. Still good GDP growth. Corporate profits, that's a pretty good swing. They're thinking between 7 and 17%. Even if it was on the low end of 7, look at 2019, we were at 1% versus 7 to 17%. So we should really see a decent year in the market, but it will be subdued from last year. Consumer price index that we just talked about, they're looking at 3 to 4%. So all in all, inflation should come down. Our corporate profit growth should come down. GDP should come down, but not to a level that should concern us. It's still higher than our normal average GDP rate. So still should be a good year in the market. So let's look back. Ed, why did Magnolia do what you did during the pandemic? We stayed invested. Well, this top graph shows, diversification. We run diversified portfolios, so we feel we're really good we're really well diversified throughout the market. But this is showing during the pandemic. So we had our low point trough in the market. And let's just take the green line. This is the S&P 500. The low point was March 23rd. By August the 10th, it was back even to where it was on February 19th. Back even. That's a pretty short window when you had that kind of drawdown in the market. And then long term, in December 21st, way up from where we were. So if you look down here, the 20-year average returns by asset class. So if you just look at the S&P 500 or a 60-40 portfolio right here, which is a lot of people are in that 60-40, 60% stock, 40% bonds, This is the average investor's return over those 20 years, 2.9%. The reason the average investor is at 2.9%, it has nothing to do with the choice of their investments. It has to do with the choice of staying invested in the market. So it's not what they invested in. It was the staying invested even during times of uncertainty. And so when we look back, as Ed, y'all stayed invested, you did not, if anything, we bought down into the market. It's because if you're invested in the market for long-term growth, you have to stay invested. Okay. And then this once again proves that point as to why you have to stay invested, because when you sell and get out, you have to be right twice, because you then have to be right when you get back in. And as you can see here, that you didn't have a whole lot of time to get back in before you had lost the ground that you had already lost, and the market was already off and running again. So staying invested is a big key to financial success. Y'all have seen this before, but I wanted to show it last year. This shows the low point in the market, and then what we ended the end of the year kind of total S&P. So entry year returns -5. We ended the year up 27. As you can see, last year we were down 34%, ended the year up 16. So once again, another good illustration of why we stay invested. Even though we may have short-term losses in the market, short-term pullbacks, typically in those years we end the year on the positive note. Staying invested, keeping your financial plan in front of you, reviewing it, why are we doing what we're doing, is the key to success. And then once again, time diversification. And so this just shows a pure stock portfolio, pure bonds, and then a 50-50 portfolio in a 1-year time frame. Okay, from 1950 to 2021, the worst and the best and worst, best and worst. If you held it 5 years, best and worst. So you can see the longer you hold, your worst case scenario is still pretty good. So a 20-year time horizon in long-term investing. This is long-term investing. This is not your shorter-term stuff, but your longer-term. All accounts on 20-year rolling averages were positive. And then even on the 10-year, the only thing that could have been down, the worst rolling 10 years of the stock market was down 1%. So that's from 1950 to 2021. So that's why when you hear me when you come in and say, Ed, and I'll tell you, this is your long-term account. This is your growth account. These are your short-term accounts. This is for money now, and you have money later that we talk about. That's why we say money now, money later, because the shorter term is harder to predict. Longer term becomes a lot easier to predict, and why we can stay invested knowing that we don't need that money right now. So here's a couple of index definitions. You can stop it and read through all of this. And a lot of this comes from JP Morgan. They do a great job putting out good information that I can use to help you guys. But once again, we really do appreciate everything that you guys have done to help us throughout the year. We hope that that this year has been good for you. Last year has been good for you, and we hope this will be an even better year. We want to wish you, from our team to you, have a wonderful, wonderful 2022. And we look forward to seeing you in the office. It's going to be a great year. I know it. And once again, God bless, and we'll see you soon.